And Dean Mills, I'm so happy to have you here today to introduce the moderator of our next session. So I will turn it over to you, Dean Mills.
Thanks so much, Christine. I've been here for the entire discussion by Carlos Carvalho and John Griffin. Thank you so much. I appreciate your expertise and service. I'm the interim dean of the McCombs School of Business. I've been in this role since June 1st, and it's just an honor to serve my colleagues and my students. And who is going to lead this discussion, the moderator, is Phil Canfield. I appreciate getting to know Phil so well because he is the incoming chair next year of the Dean's Advisory Council. And when we have a Dean's Council, we rely on people for advice. And Phil, I appreciate being able to call you so often. He is presently the Chief Executive Officer of Ariet Capital, started his career in Kidder Peabody and Company, joined GTCR in 1992 and retired from there in 2020. And while there, he was the managing partner from 2007 to 2015 and served on their investment committee until his retirement and led their technology, media, and communications investing practice for 2 decades. Phil earned a BBA in finance with high honors from the Business Honors Program at UT and an MBA from University of Chicago. At Chicago, Phil serves on the Booth School of Business Council and the Polsky Center Private Equity Council. Here at the University of Texas, Phil is our vice chair of the McCombs School of Business Advisory Council. And we are so grateful that recently the Business Honors Program at UT was renamed the Canfield Business Honors Program in recognition of an extremely generous gift from Phil and Mary Beth Canfield. So Phil, you're going to introduce the rest of the panels, and I can't wait to listen to it all.
Thank you, Dean Mills. Thank you for that warm and personal introduction. And on a personal note, Lil, I have to say, I've really enjoyed working with you over the last 6 months. I think you're doing a fantastic job leading McCombs. Certainly President Hartzell left some big shoes to fill in the dean's job at McCombs, but you've just jumped right in with power and grace, and we all really, really appreciate that. Folks, this should be a fun and interesting panel. I think it's going to follow Professor Carvalho's and Griffin's discussion actually quite nicely, especially where we ended up. I'm just so honored and pleased to be joined today by 3 incredibly accomplished UT alumnus. These gentlemen have reached the pinnacle of their careers in private equity, in venture capital, and executive leadership. What I'd like to do today is take this opportunity to learn from them how COVID-19 has impacted businesses they run and the businesses they invest in. And this is where I think it actually ties nicely with where we ended the last discussion. I really want to tease apart as we talk to each of them, which of these changes are sort of new, like completely new things that people are doing or technologies that people are using, and which are really accelerants of trends that were, currently underway. Most importantly, I really want to learn from them and gain their insight onto which of these trends and opportunities they think will persist, and how that persistence of certain behaviors and uses of technology is going to create investment and business opportunities that we should all be aware of. So before we dive in, let me introduce our panel today. First, we have Chip Kaye. Chip's a graduate of the Plan 2 program at the University of Texas. He graduated a few years before me in 1986. He's the CEO of Warburg Pincus, a fantastic, very high-performing private equity firm. He spent most of his career there. He led the operations and really built Warburg's operations in Asia, lived there until '99. Chip's also a member of the Council on Foreign Relations. He's co-chair of the Partnership Fund for New York City. And he's on the board of the U.S.-India Strategic Partnership Forum and also vice chair of New York Presbyterian. Chip, welcome. I'm also pleased to introduce Bill Gurley. Bill is undoubtedly one of the most accomplished and successful private venture capitalists of our generation. Most of you know his name. He's been a partner at Benchmark for several decades and has invested in a ton of highly successful businesses, many of which are household names like Grubhub, OpenTable, Uber, and Zillow. As you might expect, Bill has a degree in computer science. He got that at the University of Florida, but I think his business savvy and investment judgment are rooted in what he learned while getting his MBA at McCombs. Hopefully, we'll find that out as we talk to Bill. Finally, please welcome Chris Cartwright. Chris and I have known each other for a long time, I think over a decade. Like me, he's like me until recently, he's a Longhorn who learned to survive the Chicago winters. I chickened out this year and moved to Austin. Chris is still there. I think we first met when Chris was at Wolters Kluwer, and my old firm GTCR was recruiting him. Chris ultimately left Wolters Kluwer to become the CEO of Decision Insight, and today Chris is the CEO of TransUnion, which is obviously a household name. It's one of the leading providers of information or credit information services to banks, owners of real estate, and also the public sector. He graduated with an MPA from the McCombs program. So welcome, Chris. Gentlemen, all of you, thank you for joining me in this in the panel this afternoon. I'm gonna start, folks, by asking each of the panelists a fairly open-ended question, and while I do that, while I answer, I'm gonna probe a bit on some of their answers and tease out perhaps some questions that you have. But I'm sure you folks will all have questions, and I think you can do those in the Q&A box. Or raise your hand, and we'll come to that after I've had a brief conversation with each of the three panelists. So the structure of the question really kind of comes from my own experience in investing at GTCR and personally. And one of the big observations that we've seen in our portfolio is just a massive increase in demand for broadband services. So at GTCR, we had a kind of a secondary, tertiary market cable business, and we saw customers immediately calling and asking to move from 50 meg service to 100 to a gig. And it's interesting. I mean, this clearly, in my mind, fits in the category of a trend that was already going on. But COVID-19 and the requirements to work and school from home really accelerated that. So kind of with that in mind, I wanted to circle to each of these folks. And Bill, I'm gonna start with you. With that kind of framework in mind, what have you seen? What have you seen at Benchmark, and what are the opportunities you guys are seeing? And also, how has it just changed the way some of your businesses operate?
Great. Well, thanks for having me. I'm excited to be here. It's been a really interesting year. So, it's hard to believe that everything that's happened has happened within a calendar year. So, when January came along, there was no COVID, at least not on a broad scale. And slowly, as we got into February and March, all of a sudden we're facing a situation that's really unprecedented in our lifetime. And I think the first reaction in the venture community was to get conservative very, very quickly. And partly this becomes because some of the participants in the market, like myself, have been around for a couple of decades, and we've seen what economic shocks can do to the venture industry, and it's pretty profound. That happened in 01, and then it happened again in 09. So we had seen a couple of these happen, and we hadn't had one since 09. So the timing seems like it's plausible that could happen again. And there's famous pieces of work like the Sequoia PowerPoint deck that said in good times from 09 that teaches people how to react in these situations. And so the first reaction from most experienced, both venture capitalists and founders, was, oh my God, we need to tighten up the ship. We need to cut headcount. We need to do all these kind of things. And the other thing that happened kind of simultaneously was the investment community, and this is partially driven by the fact that there's so much cash everywhere, which was discussed earlier. The investment community that had been around started gearing up for taking advantage of opportunities. So you had these kind of simultaneous actions going on. What happened next was completely outside of my realm of what I thought was possible, which is, people had talked about a V-shape or a U-shape or a J-shaped recovery. And we had, from an economic standpoint, financial markets, we had an immediate pop back. I can only speculate that the availability of capital and the number of people that went out and decided they were going to take advantage of this. I mean, the time where you could buy stocks at a discounted measure was like a 2-week period. And then it was gone, and it was immediately gone. And I think some of the Fed programs that were discussed earlier played a role there as well, because in 01 and 09, capital became scarce. And when capital becomes scarce, that has a massive impact on the venture capital industry and all the startups that are there. Here, that never happened. Capital never had, and if it did, it was a couple of weeks. And so funding has remained quite liquid in our world. And as a result, kind of everything's popped back. I think the other thing that happened is, from an economic impact standpoint to tech companies, this thing didn't turn, there were, and this was also pre-discussed, but there were some positives actually that were starting to happen. And I would say, if I looked across our portfolio, 10% of the companies got hit with the unlucky stick. And if you serve travel, I work on a company that served catering and events, and those are just gone. And if you're one of those types of companies, everything just went away. There were 10% of the companies that got hit with the lucky stick. Maybe it's more than 10. Some of the ones, Zoom, obviously we're on right here, and you can see that in their stock price. Even companies like Peloton, I think, had heavy positive bias to what's happening. And so there were a number of them like that. I think what was probably most surprising, though, is that vast middle, that 80%, who I think would have expected their numbers to be, 50% year over year or something like that. And I've actually done some studying where I've gone through and looked at a lot of the public tech companies, and I looked at what the analyst expectations were in January and compared them till now. And in many of the tech sectors, those numbers are down about 5 to 10%. So not very material at all. And so you say, well, what happened? And there's a phrase that's going around that COVID accelerated the future. And so for many technologies and industries that the tech companies serve, things have actually exploded as demand for more of these services like Zoom. And there's a ripple effect. We mentioned Zoom, someone mentioned e-commerce. So e-commerce has been on fire relative to in-store. If you're ramping or scaling those types of systems, you're buying databases, you're buying analytics tools, you're buying all this other stuff. And so it hasn't been, as big a hit to the venture capital industry as we would have anticipated. Had capital gotten scarce, I think it could have been an entirely different deal. And as a result, there's been some interesting learnings in just how small companies deal with crisis. I've seen a couple of companies really that were in that unlucky category. I've seen them really, have to scramble. You know, they've had to suffer through layoffs or try and find new customers because their old customers aren't in business. And I'm always, having been in the venture industry for a long time, I'm always super impressed with the resiliency of a company, and even these small little ones. And I'm really proud when I see entrepreneurs that can move through that. We had a really bizarre situation with a company called HipCamp. HipCamp is a Airbnb for camping, where people can turn their extra land into a competitor to KOA, a much better competitor than KOA. But when COVID hit, their numbers went in the tank. They did, I think, 1 or maybe 2 layoffs. But as COVID matured and people realized outside was better than inside, their numbers went up like 7x in 2 months. So they got seesawed and flipped, and now things are on fire there. And you may have heard, like, RVs are sold out, boats are sold out. Like, there's all these things that weren't, I think, obvious as we moved into the pandemic. I think the big thing looking to the future is that this notion of accelerating the future. We've seen a number of trends that I think will, as was also already discussed, have a permanent impact on our world. The work from home thing is just huge, and it's subtle. You know, we work with a company called Elasticsearch, which is a public company. Their engineering team's been 100% remote from the beginning of the company. And so that's now an engineering team in the thousands. And we're now seeing companies we're funding that are starting without an office. I don't know how far this will go. There are CEOs like Rich Barton at Zillow who's going to try and be virtual most. So he wants to reduce the square footage per employee by about 60 or 70%. There are people on the other side like Reed Hastings who says we have to get back, we have to be in person. So I'm not here to tell you every single company is going to go wildly virtual, but you do see anecdotes that are interesting. I was talking to a CEO of a startup who had been struggling to find mobile engineers, and once they opened their brain to think about, well, maybe that person could be anywhere on the planet, they all of a sudden had a very different pipeline of resources. And I think about this as a massive positive because I think about optimization of human capital and where they might be around the world, and how, you know, getting to Silicon Valley or affording to live here is a real problem. But now all of a sudden, if skill sets can be matched from wherever you are, it should be a massive positive for society. So I'm really bullish about that. When new technologies come along, you know, we might have processes that are the fact of how we've evolved that we don't necessarily want to get rid of right away. And this shock to the system may allow us to experiment with some models that could have profound impact. Just a few others I'll mention. Telemedicine. There were a lot of regulations state by state that were prohibiting the use of telemedicine, and there were certainly some economic barriers, the way that pricing works, and all of a sudden that got blown up. And so I think everyone in the healthcare industry is now realizing telemedicine can have a huge impact. And so that's going to be exciting to watch. Sales productivity was mentioned. You know, a lot of our companies, you know, one of the reasons why I think those numbers aren't that bad is you got a salesperson that's doing, you know, 4 times as many interactions in a day because they're not on planes. And I think that's going to, you know, have a big impact.
And Bill, can I jump in and just ask you to follow up on that, on the Salesforce productivity? And people, economists have long talked about all the investment that's been made in technology, and yet we're not seeing it come through inefficiency. That strikes me, and productivity really, that strikes me as one where there's just such a sea change. We were sort of forced into a behavioral change because there was no other way to do it. And I mean, that's got to persist, doesn't it? Sales folks being more productive by using Zoom.
Yeah, I mean, I've never agreed with those broader assessments that you just talked about. And anyone that is fascinated by that topic, I would encourage them to read Matt Ridley's 2 last books. But his new one, How Innovation Works, I think goes through 500 years of history of how innovation drives productivity. A long time ago, I did a presentation talking about how we evolve with our tools. And, one proof that of the impact of technology would be to say, hey, try and run a bank without any IT systems. Like you couldn't possibly do it. And so part of the productivity, I think, gets pushed into competitiveness. And so, it doesn't mean, and those efficiencies then are found in how productive a company can be. And so, yes, if it turns out that a sales force is way more productive this way, then the other thing's not going to happen. I would highlight on that point that there might be negative ramifications, for business travel, for companies like Hertz, for commercial real estate, which could be a big impact of a trend like this. So anyway, that's really the majority of what I had to talk about.
Thank you so much, Bill. That was fascinating and interesting, and really appreciate the thought you put into it. Let's go to you, Chris, and kind of get the CEO's perspective and what you guys are seeing at TransUnion and how you've been able to operate through this.
Yeah, well, again, Phil, thanks for having me. It's always fun to get back involved with the university. And this has been an amazing year for all of us, and certainly at TransUnion. Like Bill said, the beginning of the year started off very strong, and we were enjoying one of our stronger quarters through about the middle of March, when the pandemic really began to impact the nation, and also the various countries that we operate in around the world. And there was a sea change in our activity, right away, as fear set in, as quarantines were affected, and really as just uncertainty was introduced across, economies. And, Bill talked about how in the investment community, when there's uncertainty, the brakes get put on and people start to conserve capital. And then once they get a sense of, the environment they're dealing with, then they may become opportunistic or aggressive. It's very much that way when you're running a business as well, where, when you're uncertain about the condition of your customers and the potential demand trends that you're facing, you really have to put a halt to your plans, your expansion plans in particular. As we were still enjoying a nice economic, multi-year economic expansion. And 2020 was likely to be a continuation of that. But immediately we put in place, hiring freeze. We stopped travel. We stopped entertainment. We began to review our capital spending because we as a management team and felt a responsibility, and certainly our investors expected that we would, focus on preserving liquidity and making sure that we would remain viable, especially given that there was so much uncertainty and fear around just how profound a crisis this was going to be. So we did all of those things, and it was very rough for about a month. And then, in the middle of April, we saw businesses and consumers begin to rapidly adapt to digital commerce. And, parts of our business that we support, like automobile financing, which initially were completely shut down because, consumers couldn't go out on a Saturday and walk a dealer lot and talk to the F&I department around, terms. Well, they rapidly converted to a digital experience, and they began, putting more of the inventory online, providing internet-based access to various financing options, having their salespeople Zoom with prospective clients and engage in the selling process, the informing selling process that way. And right away we saw, uptick in activities in auto lending, and also in the mortgage space, not just in mortgage refinance, which exploded because of the lowering of interest rates by the Fed, but also in mortgage, in home purchase activity, which again started to get converted online. And I think that really speaks to the trend that Bill was referencing, which is COVID has accelerated the ongoing trend of digitalization, if you will. And we've been experiencing it across multiple aspects of our, of our economy and our social interactions for well over a decade now, really since the rise of the public internet. But this was a sea change. This was a quantum leap because it was a tremendous forcing mechanism. I've been in business long enough to launch many different products. And the hardest products to get traction in the market are those where you're changing human behavior. We're actually not very adaptable, right? But when you have a mechanism like this that forces a rapid transition in behavior, that can make all the difference in the world. And so what I see happening now is for operators like myself, we're having to accelerate our investment in technology and digitizing our own processes because the market has demonstrated that they're willing to consume services, whether they be a range of e-commerce services or financial services. And even before COVID, financial services was going through a very profound evolution, given new competition coming directly from Silicon Valley, where smart engineers and tech-savvy entrepreneurs were rethinking the experience of engaging in a loan or a credit origination process, using technology and information and real-time decisioning to create a much more pleasant experience and a better outcome for consumers. Well, that is just accelerated and cemented. And so frankly, we're actually been quite fortunate. The first month was rough. We saw the market adapt. And then we actually saw consumers, at least a good portion of the US consumers, get stronger as a result of a variety of kind of macro factors that came into play. So the first thing that happened was obviously massive layoffs, which is incredibly unfortunate and something that we're still dealing with. But because of the degree of government intervention, many of those laid off consumers sustained an income that was at or above the income level that they'd enjoyed previously. Then on the other side of the equation, a lot of lenders and landlords entered into forbearance periods. So they weren't collecting on debt and they weren't requiring payment for rents, nor pursuing evictions. In fact, various governments had eviction moratoriums. And quite broadly across this country, the collections industry, there was a moratorium on collection. And then when you add on top of that, a dramatic restriction in the consumer's ability to go out and to buy things, right? So consumption went way down. So what you've seen is the net savings positions of consumers improve across the economy, and actual delinquencies on financial products have fallen. And our business, we are a broad, diversified provider of credit and other financial information that financial institutions use for marketing and credit risk management. We've rebounded nicely, and we actually, we have a very good chance, and this is not guidance, it's aspiration, but we have a very good chance of actually growing organically this year. Now, the other thing it's allowed us to do as a public company, one of the most challenging things about being a public company is the market expects that your business model has matured to a point where you can deliver consistent growth, consistent profit improvements, and EPS growth. And the ideal is if you can do it and compound on a quarterly basis. That's not always possible. And actually, I've worked for private equity a couple of times in my career, and both of those experiences have been very interesting and positive because private equity can step in and take a company dark and make transformational investments in the early part. And we enjoyed that at TransUnion, where initially we were taken private and invested in aggressively, and then we've emerged into the public markets. Well, we have additional plans to transform our business, and we were able, once we convinced our investors that we were stable, we were able to go to them and say, hey, this is actually a great opportunity for us to accelerate our investment in technology replatforming, in our real estate footprint, in refining our operational processes, et cetera. And we're going to use this pandemic to retool, because investors aren't expecting that perfect upward quarterly improvement in top line and bottom line. So we're executing kind of a next gen, if you will, for our business during this period, and investors have given us the permission to do so. Our stock peaked at about $100 a share. We trade in the high 80s to the low 90s, depending on what's going on in the news, and I think that's pretty solid given the potential improvement in our business in the future as a result of these investments. So let me pause now, so Chip has an opportunity to weigh in.
Yeah, thanks, Chris. Chip, let's. Chris gave you a really nice segue, especially with the private equity plug is a great model for corporate ownership and governance. What are you guys seeing at Warburg?
Sure, thanks, and always nice to have a positive transition in our industry. So a few thoughts. So first, I think when you sit in the middle of a crisis like this, the question is always, is this one of those fundamental turning points when everything that sort of comes after feels different? Or is it more a slow return to normal as the crisis fades? And it's always a hard thing to know when you're in the middle of it. There's a propensity to always want to see things as always these fundamental turning points. And, the only comment I'd make is, as you've heard already, and I would reiterate the same thing, what we've all learned the last 6 months, 8 months, hasn't been what we all would have thought. So our ability to predict much about anything is low. And so it's your ability to kind of deal with that uncertainty as opposed to sort of think you have some ability to kind of predict it to a great degree. I do think there's some big broad questions to make sure we all sort of, think about. One is what continues to happen with the virus itself, what we continue to know about it and what path it takes. But even beyond this one, it's important to realize it'll likely happen again. We live in a world where this kind of biological threat is more apt. And so the real question becomes, what lessons do governments and businesses and other societies draw that prepare us better for what happens the next time? We've certainly seen that distinction if you looked at sort of how a number of places in Asia that had to deal with SARS dealt with this versus other places in the world that hadn't. We're clearly testing some of the limits of globalization in terms of political and social sentiment. You hear lots of talk of sort of schism between the US and China. Without spending too much time on that topic, it's one of those easier to say than do things. I think that remains one of the issues that has clearly changed, not just as a result of the virus, but as a result of sort of politics, both here and there. I think as an investor, we feel likely to live in a world of much lower rates for a much longer period of time. I think we've learned, and I think the impact of that is big. And so when you think about, well, why is it that markets have boomed to the degree they have done since those sort of 2 weeks that Bill talked about? I mean, lots of people have lots of reasons to talk about, but one of them is low rates implies a change in asset values, especially for things that have demonstrated resilience and growth associated with them, which is why the epicenter of that recovery has been in around tech, and why we sit here today with 5 companies that are a quarter of the S&P 500 and 20 that are half. And there have clearly been winners and losers. I think, as Bill sort of talked about, the losers have been pretty concentrated. If you looked at kind of travel, hospitality, air related, and energy, they're about 10% of the economy, and they were off about half. Said differently, very disproportionate relative to the burden they bore of the aggregate downturn. And I think each of them will be, have differing paths back, energy included, which is probably relevant for any conversation that takes place in Texas. The last thing maybe one, on the other hand, there will clearly be some big changes in places. Bill referenced telemedicine. I see versions of it both because of our ownership of Summit City MD, which is a big multi-practice physician group, and urgent care centers. It's probably been one of the largest administrators of both antigen and tests broadly, about 2 million of them done since the beginning, both in that and through the hospital whose board I sit on. You know, telemedicine's been one of those things that was talked about forever, and it feels like it jumped the chasm in all this. And it's not just the regulatory issues that Bill referenced. A lot of this relates to reimbursement and the like, but I think that is a big, huge, important change in obviously a very large sector in the economy. I think there's always been this view that how do I see a doctor if I'm not physically there? I think that's clearly one of the spaces that changes. You know, we're on a conference for a university. Education has clearly another one of those places that have been threatened. And I think there are some incredibly difficult conversations for people to have. As somebody said, the idea of college being, I know, a $50,000 a year Netflix subscription is, you know, a fundamental challenge for educational institutions to kind of figure out. You know, I mentioned one where I was catching up with you before this, which is, you know, urbanization and the move to cities has been obviously one of those trends that has been at play forever, and we're seeing maybe dimensions of this get challenged in the context of this. But you know, what's temporal and what isn't. And the last one, I just to make sure I'm not sure how completely relevant it is, but it's clear that what this crisis, you tend to think of something like a pandemic as affecting everybody equally. In other words, the odds of any one person getting it, it's indiscriminate. The virus doesn't know, you know, what who someone is when they. The other hand is it has clearly served to exacerbate a number of divisions across income and across race and across the world. And those social divides around inequality, I think, may be the single biggest issue that sort of floats out of this. And even in the context of a conversation where we all, you know, talk about what has clearly been a much more benign recovery for big, large portions of the business landscape. In many ways, a vibrant investing period of time. Certainly it has been for us in every dimension we could pick. And yet the human costs of this are pretty tragic. And I think large swaths of that sort of unseen.
Yeah. Thank you, Chip. Can we, Christine, can you let us know if you've got questions for the panelists?
Yes, thanks so much, Phil. We have a question that's come in from Randall. So Randall says, Bill mentioned negatives for commercial real estate. How bad will it get? And is this mostly office or also retail in long term?
So I will qualify my answer by saying I've never been a real estate investor, and there are plenty of people around the world that do that for a living, so they'd be in a better position to answer it. But I think it could impact both. I think the one that's more profound is the commercial real estate, just because I think online or physical retail's kind of been under threat from disruption of e-commerce prior to COVID. So that's a trend that may be pushed more. But we've already seen it, right? Neiman Marcus and others are, you know, closing stores. And so it's very difficult, I think, on the retail side. But the one that's new, I think, is on this commercial real estate side, where if a company, let's say Zillow is an outlier, but let's say if every company can target square foot per employee that's half of what it once was, that's pretty impactful.
Yeah, if I could just add to that, you know, my personal anecdote is, you know, certainly TransUnion is scrutinizing our real estate footprint, and, you know, we have active plans to consolidate it. And I don't know one business operator who isn't looking to that as a source for efficiency going forward. And it's not just that we will buy and lease less commercial real estate, we will, but, you know, we will configure it, we'll outfit it in ways that support collaboration and periodic usage even more than we have been doing for the past decade. in the end, I think it's going to be kind of a net good because, the technology has always come with this promise of liberating us, right, from some of the unpleasantness. And it certainly has. And I agree with Bill that technology has been a tremendous driver of productivity, although I'm familiar with arguments on both sides. But telling an employee that they don't have to commute an hour each way and suffer the cost and the friction 5 days a week is a huge gain. And knowing that that person can still be engaged and equally or even more productive than they were before, it is a great development, right? And I think it's going to take a lot of the cost pressure off of living, in the major metro areas where so much of our talent and innovation is. But I think those metro areas are still going to remain important hubs. It's just going to be more balanced.
I don't want to
Great,
add
we have
anything.
another,
Go ahead,
oh, go
go
ahead, Chip.
No, please go ahead. Fine, go ahead.
Let's see, we have another question from Jeffrey. Jeffrey says, how do you all see positioning UT for future development of business leaders?
Wow, that's a great question. I'll start off on that one, and a little bit of it is a bit of the personal story that we had behind making the gift to the Canfield Business Honors Program. I grew up in Houston. I grew up in Texas, and I wanted to study business. And I had the college conversation with my dad, and he's like, "Well, UT is a great school, and you live in state, so you're going there." And I said, "Yes, sir." That I think probably for Chip and Bill and Chris, it was our folks our age, it was a bit more like that. The transformation that I'm seeing is the recognition on the national stage and really trying to make investments that accelerate that. That was a big part of what we wanted to do with the Canfield Business Honors Program. I think that program, before our investment was competitive with really any and every school in the country. And it had that perception in Texas, but probably not nationwide. So that's a big thing. And I would also add, I was just on a call with the president yesterday, I believe, or day before yesterday. And that's a big part of what President Hartzell is talking about, is really using capital and using alumni support to do things to market the university outside of Texas and really build the brand of the university, build the brand of McCombs, nationwide. And I know, we have a center in New York, right? You've probably been there, Chip, with the president, and also in California. And I think it's doing things like that to just elevate the stature of the university on a national basis. And I think that's going to have tremendous value for all of us. Christine, you want to go to another one so we can get, I talked too much on that one.
Sure, and this will be our final question. We have a question from Jason. Jason says, do you have thoughts on a potential government-run credit bureau?
I guess that one's for me.
Not me.
Not me.
Well, Jason, thank you for that question. One interesting thing about becoming a CEO is that you do spend a good portion of your time engaged with legislators and regulators, kind of explaining the role that your company and your industry plays in the broader U.S. economic fabric. And, clear, accurate, comprehensive, and objective information about how individuals manage their financial responsibilities is extremely powerful. It really underpins the trust that exists and needs to exist between providers of services and consumers of services, right? Particularly if those services are going to be procured using borrowings, using debt. I think currently the industry does a really good job, right? There are three major US players. Those are three global players. And if you look over time, even though industry share is concentrated amongst the three of us, the value per dollar provided has just a great upward improvement, right? There is a lot of price competition. There's also a tremendous amount of innovation as the players have moved from providing, reports and analytics on credit payment behavior to a more holistic profile of a consumer's financial wherewithal and durability. So that's income, that's checking information, that's payment behavior across categories such as wireless, telecom, rental payments, et cetera. And all of that allows lenders to more efficiently allocate their capital and manage their risk. That's the benefit from the business side. The individuals, they get to acquire things that are meaningful to them earlier than they otherwise could. So, my argument in short is like, we operate effectively for pennies on the dollars today. Businesses can gain access to that information. The information has proven predictive value, not only in a financial, but also in a rental context, an employment context. And we've had to demonstrate the fact that it is unbiased into any number of government regulators over a multitude of years. So it all boils down to this: given that the private sector is functioning, why do we need a public option?
That's a great wrap.
Thank you so much. And with that, we are out of time. And Phil, I wanted to thank you so much for leading our discussion today. Chip, Bill, and Chris, thank you so much for your great discussion. We're so lucky to have your expert insights.